Dirty dealings, corporate battles, consumer wars. This is Evening 5. JP Morgan has upgraded its stance on Malaysia to neutral after almost 6 years of keeping an underweight rating on the country, citing policy reforms, data-centred investments and a significant infrastructure build-out. In an interview with CNBC, JP Morgan head of Asia Pacific ex-Japan China, Rajiv Batra said the pace of progress in Malaysia has been surprising, with the country recording a 4.2% gross domestic product growth in the first quarter of this year and earnings growth tracking around 10% to 11%. The bold move to cut subsidies, meanwhile, saw savings being redirected towards productive users in the economy, from enhancing literacy to progressive wage policies. The upgrade in Malaysia's rating is also reflective of a governance reset in the wake of the 1MDB scandal. Rajiv noted the passing of pivotal policies and reforms, including the National Energy Transition Roadmap and the Madani Economy Budget, as well as Putrajaya's commitment to fiscal consolidation without sacrificing growth. Meanwhile, foreign investors are returning after initial outflows. Notably, year-to-date, the bellwether index FBM KLCI has gained 11%, while the FBM 70 is up 28%. Meanwhile, the ringgit has strengthened by more than 2% against the US dollar from its over two-decade low in February. Separately, JP Morgan also upgraded its ratings for Malaysia's equity market, recognizing it as a standout performer in ASEAN. In a note, it said it has raised its KLCI target base case to 1,650, up from the previous 1,500, with a bull-bear scenario of 1,700-1,500. Bank Negara Malaysia kept the key interest rates unchanged at 3% amid resilient economic growth and manageable inflation. It was a widely expected decision. A survey of 22 economists by Bloomberg had unanimously called for BNM to stand pat on the overnight policy rates. Going forward, the central bank expects exports to be further lifted by the global tech upcycle, given Malaysia's position in the semiconductor supply chain, as well as continued strength in non-electrical and electronics goods, while tourist arrivals and spending are also poised to rise further. BNM has kept the policy rate unchanged for over a year now, since it was last raised in May 2023 by 25 basis points. It said the monetary policy stance at the current OPR level remains supportive of the economy and is consistent of the current assessments of inflation and growth prospects. BNM flagged a pickup in inflation in the second half of 2024 amid the recent rationalization of diesel subsidies. Still, it believes the increase in inflation will remain manageable, given the mitigation measures to minimize the cost impact on businesses. For the year as a whole, it sees the headline inflation rates within the earlier projected range of 2 to 3.5%, while core inflation should come in at 2 to 3%. Astro Malaysia Holdings said 2 of its subsidiaries have been served additional tax demands totaling 734.88 million ringgit. In a bourse filing, the content and entertainment company said Astro Shaw has been served with additional assessment notices by the Inland Revenue Board, or IRB, for 22.01 million ringgit. Meanwhile, Mirsad Broadcast Network Systems received a tax demand for an additional 712.87 million ringgit. The figures include penalties imposed by the taxman. Astro said the notices were raised because the IRB disallowed production costs claimed during those assessment years. It said its subsidiaries have been given 30 days from the date of the notices to appeal against the IRB's decision, adding that the group believes there are fair and reasonable grounds to defend against the said notices based on legal advice obtained. The units plan to appeal and, if required, initiate legal proceedings to challenge the basis and validity of the IRB's demands. Astro said it will provide updates from time to time of any material development to this matter. At closing bell, the stock settled 1.6% higher at 31 sen for a market capitalization of some 1.6 billion ringgit. Economy Minister Rafizi said the development of the Johor-Singapore Special Economic Zone's infrastructure will be co-financed by the government and the private sector. Rafizi said the Malaysian government has informed its Singaporean counterpart that it will not blindly allocate funds for infrastructure development and instead execute it in collaboration with private sector investors. He told the Dewan Rakyat during today's ministerial explanatory session that the government will only consider establishing an infrastructure fund when there is private sector investment. Rafizi said this approach aims to prevent the government from repeating past mistakes and to mitigate the risk of wasting taxpayer money on infrastructure. Previously, he explained, when there was a new industrial zone, Putrajaya would spend money on the infrastructure and then seek investors, which meant it couldn't determine how much allocation was needed for infrastructure. Rafizi noted that this strategy would also ensure that the economic zone attracts global investors and draw their focus from Vietnam, another favoured investment destination in ASEAN. He said the cross-border zone would be able to offer global investors the best of both worlds, the sophistication of Singapore and the resource and cost advantages of Johor. Shipbuilder and shipping company Shin Yang Group is acquiring stakes in car dealership companies in East Malaysia to diversify its revenue streams and leverage on the target company's networks and client bases to cross-sell the group's shipping services. In a filing with Bursa Malaysia, Shin Yang said it inked two separate conditional share sale agreements amounting to 144.5 million ringgit. The first was inked with Shin Yang Holding, KTE Motors and Shin Yang Group Managing Director Ling Cheong Sing for the entire equity interest in Boulevard Jaya. The second was with Dwi Bumi Jaya for a 60% stake in Boulevard Motor Sabah and Boulevard Motor Labuan. Ling is also a director of Shin Yang Holding, Dwi Bumi Jaya as well as the target companies. The related party transaction will be satisfied via the transfer of 55 million treasury shares to the vendors and the balance in cash. The proposed deal will be financed via internally generated funds and is expected to contribute positively to the future earnings of the enlarged group and strengthen its future performance. The deal should be completed by the third quarter of 2024.